In fact, let's also get a listen in then to Surendra Goyal as to what he believes investors should do at a time of this turmoil and the kind of hit that he believes India Inc. will see on account of the lockdown.
Okay, so to answer that question, Nikunj, let me just kind of step back a little how we were thinking 1 month back and what we are thinking about the market now. And as you rightly said, this is a very unprecedented kind of situation, kind of event. And because of that, there are a lot of unknowns. And in this kind of a situation, forecasting obviously becomes that much more difficult. Now, if I step back a month back when we put out a report where we set a 1 year or a March next year Nifty target of 10,000. Okay, at that point of time, the Nifty was sub 8,000, and obviously it was falling every day. So there was a lot of pessimism. But when we kind of went back to the basics, which is the indicators that we look at, and these are like fairly simple things like bond yields and earnings yields, the differential between that. We have a sentiment indicator which kind of bakes in a lot of variables, 11 variables, and it comes out with a reading on how much pessimism is there. And when we looked at all of that, it was looking quite attractive from a historical perspective. And then we said that obviously right now there is a lot of pessimism. Things are looking very, very difficult. There are a lot of unknowns. But as we go forward by, say, September, October, FY21 will obviously be a very tough year on earnings. But FY22 on a low base, if it looks like a normal year where GDP can go back to, say, 5.5%, 6%, then at that point of time, the market will be looking at FY22 because FY21, obviously, people will realize is going to be a super difficult year. And on those earnings, okay, so you take FY21 earnings to be very weak and FY22 earnings to be high on a low base. And on that, if you take a 17-18 multiple, which the market has been trading at over the last 4 or 5 years since domestic flows have been strong, that kind of gives you a Nifty target of 10,000. So that is how we arrived at that target at that point of time. Now, what has happened in between in the last month or so is that the market has rallied 25% in a straight line. Okay, and obviously it perplexes a lot of people, but my view on that is a lot of negativity got priced in when we saw the big fall of, say, 25-30%. And then what happened is, as you have seen in this earnings season, as the results come out, if they are not very bad, actually the stocks are going up. So in my view, a lot of negativity got priced in, and then that is what kind of helps stocks do better. But having said that, 25% returns in a straight line in this kind of a scenario is a lot. So for now, we are maintaining our March Nifty target of 10,000. And we would be recommending people to buy the dips because clearly the market has done very well from the lows over a very short period of time.
Okay. Now, in the short term, Surendra, market are a function of technicals, flows, macro, positioning, and also fear. So in the short term, we don't know where the markets are headed. So let's talk about medium term. In your assessment, do you think markets are still slightly optimistic on FY21 and FY22 earnings? Because most of the corporates, Surendra, we've spoken to, we had Axis Bank in the morning, we had Infosys last week. All of them are saying that, look, we don't know what's coming next because we frankly are not in a position to give you guidance. So in that kind of a scenario, how does one go about understanding and penciling and calculating EPS growth or EPS compression for this year and next year?
Okay. So I think I'll say two things here. Firstly, in terms of how people are thinking and how people are positioned. We did a survey of investors, the buy side, and 100 plus buy side folks participated in that survey. And interestingly, more than 65% of them thought that the market is going to test, or Nifty is going to test 7,500 again. So clearly from a sentiment perspective, and this was done maybe 10, 12 or 2 weeks back or so. So sentiment perspective, things were bearish. And when I talk to people, I still feel that sentiment is reasonably bearish, I would say, right? Now, as you rightly said, that these are super difficult times in terms of forecasting earnings, and that is true for companies also. So what we look at is we look at past instances of similar kind of situations. Now, each of these one-off situations is very different, right? But we have to have some kind of a framework. So what we did is we put out a note even as recently as last week, where we looked at nominal GDP growth. Okay, and if you see years in which nominal GDP growth has been lower than 5%, in those years, the top line growth for the listed companies has been flat to negative. Okay, so that is some kind of a framework to use in this kind of a situation, because obviously companies will also not be able to tell us. Okay, for IT companies, for example, one could kind of draw parallels from the global financial crisis. And you could see that at that point of time, how the world reacted. Now, this situation will be a little different. But in the absence of any other framework, that's a relatively decent framework to work with. So that's what we are doing now. From an earnings perspective, to answer your question, a month back, or month and a half back, whenever we did that note, what we did is, historically or in the past, we have always taken our team's bottom-up earnings forecast for the Nifty, and that is what we have used to set our targets for Nifty. But at that point, it was very clear that this was, again, a very unprecedented kind of situation, and the bottom-up estimates may get revised with a bit of a lag, okay? So bottom-up estimate at that point of time was in the teens, 15, 16% earnings growth. When we set the target, we took that earnings growth, we put a top-down expectation, which is our expectation, and we said that earnings growth will be 0 to marginally negative. Okay, and we put out this note last week where we looked at nominal GDP in this kind of situations. And we actually now saying that growth could be, say, -5, -10% for Nifty. And again, this is all looking at historical examples of how things have panned out in periods of low GDP growth rate.
Okay, that's